Good evening, everyone. Can we have a quick sound check? Good evening. Good evening. Am I audible? Let's get sound issues sorted. All good? All right. So I hope everyone's had a good trading session today. Relatively one of those easier days to trade, right? And without the thing which happened yesterday, late at the close at 2:54 p.m. in the bank Nifty. Yesterday was also a good day to trade, except for that 2 minute of madness which happened, but otherwise also it was a very dependable trading kind of a solution and situation. And today, in fact, even better, a trend day perfectly set up in the Nifty, started off very well. We spoke about that 2-day balance as having the traction for a move higher, and that is what really happened today, right? All through the day today, the market trended. We had a perfect trend day in the market with some profit booking coming into the close. And this was a classic kind of a situation. And I do really hope for yourselves that y'all could maximize. We spoke about this, the movement of the POC and a move from balance to imbalance. It is something which is very, very typical in the market profile. And most beginner traders get to know a lot about, get on the better side of trading, having spotted this kind of a situation before. So this is what we call a balance formation, and a move away from this balance is what gives the possibility of a trend day. And this is what is called a trend day, a day in which the market puts in higher highs through the day, a trend day up profile, and the lows are lower than the previous lows of the 30 minutes, and that keeps moving, and the markets tend to go higher post this. But this is the situation, this was the environment which we spoke about, and that created that upper move today. And this is what we've seen in the market profile chart today. Right now, today, we've gathered to speak once more on order flow, and we're going to be speaking about the order flow of the indices, the instruments we trade out of, and we'll have a look at what really happened. So this is that classic higher high pattern I spoke about. Right through the day on a trend day, you will see the market making higher highs. So even though this was marginal, the market was always making higher highs into the close, and even the last 15 minutes the market closed at the very high end. And there was a trigger right at the open, and all this buying which came in right at the open in the A, B, C and D periods was the trigger which the market was looking for the trend day higher. So the buyers were right there in the opening bell, and the LLTs were there, the large lot traders, the buying which happened. And subsequently in the first 1.5 hours of 2 hours of the day today, right up to about 11:15, all this buying which happened resulted in the move which we saw from about a low of about 22,650 right up to near 23,030 kind of levels at the close. 23,023 was the high, and this came about because of that large order flow trading which we saw. Towards the close, right at the highs, the market saw a wave of long booking. Totally expected. When you got a 400-point move profit, it makes sense to take profit. So right over here, and some of them were booking as high as 22,940, 100 points lower than the highs of the session. We saw a lot of profit booking happening right here from this 1:45 2 p.m. window. So this is a reason the POC is shifted. It's become a kind of a selling pattern which we call the responsive selling pattern, and the market is expected to give a small dip tomorrow right up to about 22,840, maybe about 22,880, and then shoot up again towards the close. So that's the situation. Demand came off at the close, demand was added at the open, came off at the close, and the markets closed at the highest point through the day. Right now, today's session, we called basically to speak about advanced order flow, and I'll happy to answer any kind of questions which you may be having about the general order flow and the way it is to be used in trading. And just before I go into the session, I'll keep the windows open for all kinds of questions you may possibly have on this subject called order flow. I'm here to answer all those questions which you would have. Feel free to ask your questions. I'll read them out, and I'm here to answer those questions for you, right? But the topic is gonna be on advanced order flow, and I'm gonna be talking to you about two aspects of order flow through the session today. And if you hear me out, it's gonna give you a huge edge in the way y'all read markets, in the way you understand markets, right? As you know, and I don't need to stress this again and again, the markets are more faster. The markets are moving forward much more, or moving onwards, up and down, much more than any other time in the past. Right, so you're seeing the Nifty at 23,023. It was somewhere around 21,700, 21,800 hardly about 8 or 10 days back, and it's traveled the entire route up in about hardly a small amount of time. And this is not to say that the markets keep going one way only. They were at 21,850, 22,850. They dropped down to about 1,000 points. They are up 1,000 points. So this is the movement which is happening all the time, and nobody can pick up the exact top and the bottom of these movements. But the fact remains that there is a lot of opportunity for a trader who is betting on direction, who is clear on what the market happens to do next. And you don't really require 1,000-point move to make money in the markets. Once you get good at the business of picking direction, and I'll stress that again, you get good at the business of picking direction, because markets are directional more times than they are not. Most of the times they will stall and stay in one place. But sometimes they tend to move around a lot, up and down. And as derivative traders, it does not really matter to us where the direction is. You can go one way down, you can go one way up. The derivative trader is in there to use that leverage and to use that information of which way the market is going to make a lot of money for himself. And you need not capture 1,000-point move, but if you could get about 200, 250-point move straight out, like today was a classic 400-point run up, but you could have got about 200 of this 450-point run up for yourselves, you had a good day, right? You need not capitalize the entire move from A to B, but if you could pick up segments of it and know that this is the certain expected direction of the market, and you trade in that direction, you would make a lot of money for yourselves. And I say this out of a fact, because I know a lot of institutional houses, they don't bet that entire house on the next 1,000-point move, right? What they do is that they come in huge sizes and they trade for that 300-point move in the bank Nifty, for that 150-point move in the Nifty. And if you can trade about, and these are people we've seen them and we've evidenced them in our order flow charts. These are people when they add about 5,000 lots and they get about 100 points of Nifty times 25 where we are today in terms of size. Just do that math, you would know how much money they are making for that 150 points. So it's not about going for that large move. It's about knowing with a certain amount of definiteness that yes, the next 150 points are there for the taking, and you trade maximum for that 150-point move, which you know is going to go in a certain way. And that's how money is going to be made in trading, right? So we're going to be speaking today about two advanced concepts of the order flow. One is called the 10-bar COT, and this is what you would see in an order flow chart right at the very top in here. This is what is called the 10-bar COT, and it flows from the last 10 bars of the time frame you choose in. So this 10-bar COT is a representative of that last of the last 30 minutes of trade for this entire window in the time frame of 30 minutes which we are looking at. if I shift my chart to a 3-minute version, right? So this 10 bar cot is now gonna be minus 3946, and it represents the 10 periods multiplied by 3 minutes each, the last 30 minutes of trade, right? So pay attention, okay, to this number. It's not a 10-minute cot, it's a 10 bar cot, and that bar cot, okay, is dependent on the time frame, okay, you look at. So if I go with a 1-minute window for order flow, now this 10 bar cot is 3432, which is a plus. So it changes, okay, based on the time frame you are choosing. I'll go in a little bit depth about what this really means, okay, for us as traders as we go about, and then we're going to be focusing, okay, on something called the large lot trader, LLTs, okay, which we call it. The other word, okay, which we use, okay, for them are called whales. Those are the big traders, okay, who come and trade in the markets. So whenever, okay, they come about, and sometimes, okay, there is more than one particular party which is coming into trade. Whenever, okay, they come, they create a large scale movement in the indices, okay. They absorb, okay, the buying and the selling, okay, which is there, and they create, okay, a large scale move in the indices. And whenever they come, they will show up, okay, in our charts, okay, as some kind of a dot, you know, like this over here and this over here at 1027110, this thing. And they don't stay for a long time. They will not, okay, take this 1000 lots and hold it for the next 1000 points. They will perhaps, okay, see about 100-150 points of gain and move out. But whenever they appear on the buy side or the sell side, they will come up here as a dot, telling you that there is a large trader who is entered at that size, right? And it could be anywhere between 1,000 lots to about 7,000, 8,000 lots also. And you could, okay, trade, okay, with that also size. But more importantly, what it does is it tells you, okay, that there is a large trader, a large institution, a large HNI who is present at those levels, and he is basically, okay, decided on what he needs to do. All right. Now, what really happens is, in the world of markets, there are actually, okay, two kinds of traders. Okay, and one is a trader who knows a lot of things about the market, and I will not use the word everything over here because nobody knows everything about markets. There is one kind of trader who knows a lot about what is going to happen, okay, and he has plans, he has strategies. More importantly, he's got experience. He's traded in these markets before, right? And there's the second kind of trader who is new to markets, definitely new to derivatives, as not traded derivatives with size, is not confident, and virtually a beginner testing the waters in the markets, right? Now, the beginner trader does not bring a lot of capital to the markets. The trader who knows everything, the institution who knows everything, okay, has a lot of capital to deploy in the market, and they have that capital because, okay, they are confident on the way the market is going to go moving forwards. Now, in a matter of speaking, as a general rule, the flow of money in the markets, it's a zero-sum game, right? So the flow of money in the market is from those who do not know to those who know, right? And now those who do not know are a large number, very large number, okay, but with smaller capital. So you can say, okay, an average of, let's say, about 1 lakh rupees of capital, but there'll be about 100,000 of them. So 100,000 into another 100,000, that's the amount of pool which is available. Now, those who know, those institutions would be about what, 500 to 1,000 to about 5,000, maybe 10,000, right? And a large amount of capital. So all of these institutions, okay, easily trade over about 50 CR, 100 CR. Sky's the limit, okay. They have large capital, and they have capital to deploy into that strategies. The flow of money is always from those who do not know to those who know, right? So that's why, okay, when you're seeing the IPL and you see all these brokerage ads and everything, that is new money coming to the markets, and the institution sees that and gets excited because, okay, this is the revenue, okay, they are going to make out of these guys into the future. So every time, okay, these brokerage ads run, and every time, okay, new traders, okay, come to the market, and I've been a new trader myself, so I know it does not sound good when we say it, but every time a new trader comes into the market, he brings the meat to the institutions to trade out of it. And the institution knows the job of the retail is to provide liquidity to markets, randomness to markets, and positions which are not planned, which are not executed in a strategic way. And he comes at those places where the retail trader is not really knowing what to do. He seizes an opportunity, he takes a position, and he's got a planning for that position, and on that position he makes money for himself, right? What we are doing in Orderflow, by tracking in these LLTs, we are knowing specific areas where they are interested in. Like, we were live in the morning today in the entire VMR, and it was around 11 o'clock when we knew for certain that these boys had a plan and a strategy. And that dip was the only big dip of 50 points we got around 10:42 a.m. And as soon as these LLTs came in, that was a confirmation that there was a trend day which was about to come in. And we never came back below these levels of 22,740, 700 again, ever. In fact, I put out a tweet also that you keep this as a reference for the rest of the day, 22,690, because it was a very good indication that this market would stay over here and hold this level into the close. The COT, the order flow, everything was good for this market to go here. So whenever you see LLTs, large lot traders, you look at them as a sign that they are there. Now, some of them have booked profits over here. This is a sign of a stop loss gone. So this is 2,000 lots of LLT, but this is not an initiative seller, right? So you would see this on the sell side, but the market is going up. That's because this is a profit booking. The market will not come down because you see a red LLT, right? Even though that COT is marginally gone red over here, there is no IS bar, initiative selling bar. So just because you see a COT bar and some seller in LLT, does not mean that the market is coming down, because there is no initiative selling, right? Now I want to bring your attention to what the order flow is all about, and we'll have to go into the manual again to stress on what the order flow is. And the order flow is a sum of all these things, not one of these things. One of these things is not called order flow. A sum of these 5 elements make up the order flow chart. So I get these questions also on live on X, and people asking me, what do I do? This COT is this and this COT is that, and the market is not coming down. Just because the COT is something does not mean that there are initiative sellers to bring the market down, right? So there are 5 things which make up an order flow chart. COT is one of them. The most important thing in my book is the presence of RB, IB, RS, and IS, right? Because initiative traders are the ones who move markets. There would always be responsive selling and responsive buying happening in the market, but you have to wait for the clear signal to come in from order flow that there is some initiative activity happening, right? And when that initiative activity comes, I stress this word, initiative, they are taking action. They are taking the market in their own hands, and they've decided now, we're going to get a move on, right? And that, when you have, something, going on with COT, that is the time, you are going to get a proper move in the markets, right? So I hope, everyone is clear about this aspect of order flow. The LLTs, will keep coming in. They will keep booking profits, but that does not mean they will come, they will book profits, and they will make fresh positions, right? But that does not mean that the market can change direction. The market changes direction only when there are initiative buyers in the market. What we've seen over here towards the end was an IB plus IB pattern, but immediately you got negated by another LLT seller, which is again a profit booking. There was some selling which came in over here, and for a moment the market had paused before that final leg up into the close which came in. But this was a sign that the market was taking those big profits, this 1370 which came in 22,960, and the last leg was driven by that 21,900 CE closing and getting that move away, right? So this is how we look at large lot traders. I'm just going to pause for a minute and see if you have any questions to ask me, and then we'll go on to the other aspects. So the question is, how do you get a confirmation that there is a trend day at open? So all of this needs a little bit of a background and an understanding, and there is a advanced suite which we've put up for traders who want to go deeper. We do a lot of free education out on Twitter, but for those who are looking for an accelerated path and an understanding of all concepts under one roof put together, we have two programs for you. One is the e-course of 12 videos where you can look at understanding the markets in a very holistic manner. It is a very structured program. And there is a set of 12 videos which are for you if you want to understand markets, but they would explain to you the market dynamics, the nuances about how you should go about your trading day. 12 powerful videos based both on market profile and the order flow, and there is a one-time cost for this. It's 4,999 plus GST. You can watch it unlimited number of times for as many years as you want. It's yours for you. It's a one-time access, and there is also about 7 days free access to Orderflow live and market profile charts with this. So you can keep this, watch it as many number of times. I know a lot of people who have benefited immensely from this course. As a beginner trader, I highly recommend that you understand market profile and order flow because it cuts out all the noise from the market, and it clears a lot of things about the markets, right? So this thing about today being a trend day is explained in this e-course. It's one of our favorite setups. What I spoke about, the move from balance to imbalance, is also explained in this e-course. And I spoke about initiative buyers, responsive buyers, initiative sellers, responsive sellers, the role of liquidity in order flow. We've covered ground on order flow also on this e-course. Go to these terms and conditions. It's a one-time access fee you have to pay, no recurring charges. The content is about 12 videos, and it's got lifetime access for you. 4,999 plus GST. You will get an intro at our portal, and you can get it directly off this Premier Access link out over here, right? Now the other program which we have for a more active trader is the WeTrender mentoring room program. So in here, what we do is we do live hand holding with you on the market profile and order flow, and essentially you join us in a room because we trade together. You watch the market with us and you trade the market with us, right? So we'll support you, we'll support your learning. Again, in this program there is a theoretical 15 videos are given to you. A little bit more depth is given to you, a little bit of a different program than the e-course. We have give you access to what we call the training library. There are about 15 videos, more in-depth understanding of the market profile, and definitely more about the order flow is there. But what you do is you join us in a regular market session from 9:15 to 3:30 p.m. and we'll support your learning with free access to order flow and market profile charts, the same charts which everybody looks at, and you'll get those charts at your fingertips, and you would be able to watch them, and as we talk about them, and we analyze them there. There is live commentary, and we take signals based on the strategies which we talk about in the training library. There's nothing away from market profile and order flow. which we do in the VMR. So we are not going to be talking about something, okay, which is not there in the training library. So all those concepts which are pre-decided, okay, and already there in the training library, you get to see a live execution of that in the VMR, in the vTrender mentoring room. Right. So this is about those two programs. Whether you are an active trader or you're one of those traders, okay, who trade casually once in a while. If you are one of those who trades casually, then we recommend the ecos section for you. And it's a one-time clean access for you, okay, if you clean it and if you choose it. And if you're one of those active traders, then VMR, okay, is the program, okay, which you go in for. We have three options over here: the monthly, the quarterly, and the annual. And you can choose, okay, whichever works for you. And all of these plans, okay, will have access to the training library as well as access to live streaming charts. Right. Now let's go back. And here, okay, some more questions, okay, about what this is. So the question is, okay, what time frame is best, okay, to monitor the 10-bar COT? Right. Now I'll come, okay, to that question also. But just before that, I just wanted to quickly, okay, make it clear to all over here that whether you trade a 1-minute time frame or a 3-minute time frame or a 15-minute time frame or the 30-minute time frame, the most important time frame in the market is always the higher time frame, right? So the monthly chart is a little bit more significant than the weekly chart, and the weekly chart is more significant than the daily chart, and the daily chart is more significant than a 60-minute chart, and the 60-minute chart is more significant than a 30-minute chart, right? So it flows from there. The higher the time frame, the more is the weightage of the market. All right. Now, why do I say that? Is because 1 bar of 3 minutes or 1 bar of 1 minute does not make a market, right? A lot of people, what they do is like they take a signal, okay, from a 1-minute bar, and whatever signal it is, a moving average crossover or an RSI or a MACD or whatever, okay, they look at and they extrapolate that and they expect that result, okay, over the next 5 days, 5 weeks, 5 months, and 5 years also, right? There's nothing, okay, like that ever in markets. We have something called the rule of 10 bars. Whichever time frame, okay, you're looking at, hold that signal, okay, for the next 10 bars also. So if you got a signal, say in a stock in the monthly time frame, that signal is valid, okay, typically for the next 5 months. Okay. If you have a signal in a weekly time frame, that signal is typically valid, okay, for about 4 or 5 weeks, unless something changes to upset, okay, that signal, or something contra happens, right? But that is a holding period. So same thing, okay, if you get a signal in a 3-minute chart, don't expect it to hold for the next 3 days, right? The validity of that signal is 3 minutes into 10 bars, that is 30 minutes only, right? So whether Orderflow says there's a buyer or responsive buyer at 22,930, right? The validity of that signal is till the next 10 bars. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, you see a profit, you move out. And if you get a signal in a 30-minute time frame, you get a signal in a 30-minute time frame, the validity of that signal is the next 10 bars. So I'd like to bring your attention to what happened in the Bank Nifty. So there was a powerful signal, okay, which came in yesterday, and I put this out on Twitter also. So right through the day, we saw, okay, that the market, okay, this was yesterday, the market, okay, had dipped down to the value area low of the previous week, which was around that 47,800 zone, right? It dipped here right through, and the signaling was that there is no further supply coming in. You could give over here, but on the 30-minute time frame where I am, there was no signal, okay, to go long till, okay, we got this big break of this IB 2:45 p.m. So this, okay, became a signal for us that there is an IB, an initiative buyer, who's stepped up, and this initiative buying candle had a low of 47,622, okay, which became the stop loss, okay, for this signal, and we saw a directional up move as a result. Now some of these greens booked earlier today, at 48. Then they they took another trade, built some longs again at these places, caught again, went green, and finally, okay, there was closure. Okay, I'm still expecting the bank nifty to pull back a little bit because there was a lot more, okay, of responsive selling, okay, coming into the close, and the net caught, okay, of the 30 minutes is marginal at minus 1838. That's because yesterday's longs closed, they took fresh longs, again closed, and the net one is hardly at anything, right? So when you're looking at 10 bar caught, the best signaling is going to be on a 30-minute time frame. That's a chosen time frame of the market profile. I hope, okay, that is clear to everyone. The question is, does the ecos include the gamma concept, which we does? So the current curriculum or the program, okay, of the ecos does not include the gamma. Gamma is a little bit of an advanced concept. It's not covered in any of our ecos. The ecos, okay, which we have is a basic market profile and an order flow outlook to markets. So again, the question is, for COT, always remember the higher time frame. I personally choose the 30-minute time frame to understand COT, because a 1 3-minute bar is not a really true indication of any big change which is happening in the market, right? So focus, okay, on what the futures are doing. I always okay, recommend, okay, that you keep a futures chart open, because the futures chart is the best way of looking at order flow. A lot of traders, what you do is, the only chart, okay, they look at is what is given, okay, by their broker, and the only indicator they track is the open interest of the market, right? So a lot of traders, okay, they are tracking, okay, open interest, and open interest changes, and they take positions based on how the open interest in the market is changing. So this is a typical open interest table, and if people say, okay, that there is a call open interest going up, they will add further calls, and they will be call writers also. Or if they see, okay, the put open interest is going up, they will add further puts and be put writers also. Now what we are telling you is, don't follow retail traders. In fact, follow people who are creating the open interest, right? There is a difference. Okay, there is a person, okay, who's created open interest, you're watching him and you're adding open interest on it. I rather you be the person, okay, who's created that open interest, because the person who created the open interest created it with a strategy and a formula and a process in mind, right? And those formulas and strategies, if you want to understand why they created and how they created, would be evidenced in an order flow chart, right? A Nifty futures chart, if you keep open, even though it has got lower volume than the options market, the options market is predominantly 100% okay, is predominantly okay, strongly okay, the volume is driven, okay, by the retail, but the institution is the stronger player in the futures market. Not a lot of traders, retail traders, trade in the futures. So that's why when you keep an order flow chart of the futures open, you will immediately, okay, come to know, okay, what the big institutions are doing, what the big institutions are doing in terms of price movements. And when you get this signaling, okay, from COT, when you see, okay, that price is moving up and down a certain way, you get these IB and IS and RB and RS kind of patterns, and the visualization comes in and the LLTs come in, you get a cleaner idea about what the market is gonna do next, right? So always keep this futures chart open. It will tell you a lot more about what you are doing. Okay, so the question is about price action and volume action. So what we are focused on is volume action, right? There are about 3 elements, okay, which go into the makings of a chart. Price, the most important one. Supporting one is volume, and the second supporting one is time. Okay, and at different place, different days, different times of the session, and at different days of the week, each of these 3 play differently, right? So you know that between 2:30 and 3:30, because of the option plays and because of settlement pressure, because of this particular time, 2:30 to 3:30, the market works differently, right? And that point of time, the time becomes more important than price and even sometimes volume. But at certain times, let's say about 9:15 to 10:15, the volume component of the market is more important. A lot of traders are brought up into thinking that price is everything, and that concept is still there. Bhav Bhagwan Che, but Bhav is not the only Bhagwan. Bhav is not the only Bhagwan. There are three Bhagwans. One is price, one is volume, and the third one is time. And if you can pay attention to these three, especially as a derivative trader, you will cut out a lot of mistakes, which you make in derivative trading. The whole idea as retail traders is to eliminate rookie mistakes. Before you start making money, before you actually become profitable, you have to think about how you're going to be eliminating your stupid mistakes. And I'll call them stupid because I made them once also. And if you can eliminate about 70 to 80% of your stupid rookie mistakes, you're clearing a path for yourself to prosperity in the markets, right? Because if you go back and look back at your contract notes, you would see that you have made losses because of lack of knowledge and because of stupidity. And the day you can eliminate one of them or even both of them, you instantly become a better trader, right? So I've covered ground on what order flow is today. We spoke about large lot traders. We spoke about the rule of 10 bars. I emphasized. I want to re-emphasize again the importance of order flow not being one of these things. Order flow is a sum total of 5 different things: the market liquidity, the COT and the open interest, the market dynamics, RB, IB, RS, and IS, the presence of volume clusters and imbalances in order flow. And when you're going to be starting trading of COT, don't just look at it as the only indicator of order flow. A red COT without initiative sellers is not going to give you a price drop. The initiative sellers, the IS bars, have to come for the price to drop. So all this is red COT still here into the close. But price is not dropping. Why? Because there are no initiative sellers. In fact, the entire day we saw only one IS bar into the close, because that was the time a large profit booking had happened and there was no other demand to match out that thing, right? So keep looking for IS bars, initiative sellers. They are the first signal which the market is going to tell you that it is going down, right? So something like that happened right at the lows yesterday. There was a lot of signaling in the bank nifty that it didn't want to go down, but there was no signaling. There was no signaling that the market wanted to go up. And all we were doing yesterday was waiting for that signal to come that the market wanted to go up, right? So I'll just bring that part of the market because it was kind of frustrating yesterday. We knew the market was wanting to go up, but the signaling wasn't there, that the market was there. But we knew for a fact that that the market definitely was not going down. And this happened yesterday, right? So 2:54 p.m. I put this chart out also. This is a stop loss order. This is some orders which were placed in the system which did not get a proper execution price, which is why the price dropped and it became an RB pattern. But even then, the COT was green. There was a net COT which was about 20,000 for this 10 bar COT over here, but there was no signal to go long. The signal came here at 3:03 p.m. that there was an IB bar and there was an IB plus IB pattern which told us now you go long, because the COT was green. The 10 bar COT was all showing about plus 20,000. This was the indication that this market now wanted to go up, right? So look out for these signals. You're not going to get them every time because it's not in the nature of markets to give you 100% signals all the time. But I call these kind of signals my 95-96% signals, and you don't require one of them every day. But when you do get one, there is money to be made in the trade, right? This was a classic signal, IB, 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 all in the rule of 10 bars. Right? See, all this signaling has happened in the what we call the power of 10 bars, and it's a signal that the market was wanting to go. That evidence with a green COT told you that this market now wanted to go higher. When it does, you go and book your profit at the end of 10 bars, right? So it's not just one indicator, it's 5 of them. Try to get at least 3 of them working for you, and you will get one of those 90-95% signals of the market. Right. So the question is from John in how does the underlying move in relation to futures without the price of the underlying 50 stocks moving either up or down? So I'll take this question, but that question requires a lot of depth, and it's basically which is gonna take us off a tangent. But just to broadly explain, because we are all here today, the price which is depicted on your screen is a sum of all that constitutes the index. So you'll say Nifty 50 different stocks coming together, the stock price, the movement in futures, and the movement in options, right? So the price of the cash stock, the price of the future, and the price of options all come together to give you that price on the screen. The mechanism is at the exchange. How it works is a little bit deeper. We cannot touch on it right now, right? But there are certain times one or two of those stocks, let's say a Reliance, moves a little bit more stronger in the entire Nifty 50, and you'll get a larger proportionate move in the Nifty 50. And at sometimes 40 of those 50 will move, and you'll get a large trendish kind of a move in the markets. But at other times, one or two with the highest weightages, say your SBI, your ICICI, your Axis, your Reliance, your ITC, come together, and they are enough to move the index as a whole, right? So pay attention to the weightages. Pay attention to what the futures are doing. Sometimes derivative traders take large bets in the futures, which can create a move in the futures. And because it's a derivative, something needs to be offset in the cash market. And pay attention, especially to the options market, because now that zero DTE is coming, 0 days to expiry. We know that the options market is has that inventory which needs to be settled by that 3:30 p.m. window. And because of that adjustment of volume and adjustment of positions and that open interest, a lot of change can happen, right? So I hope I've answered most of those questions which have come in. We'll stay ground to the to what we've discussed about the order flow. Just these are the new things which came in, the order flow and all. A lot of it is covered in the orientation programs which we have. Make sure that you are going through it on our YouTube channel. We have a lot more detail which is there. If you are wanting to know a little bit more about what these charts are all about, we have this how to and a quick visualization about how best to use these things. And like I said, if you want to go deeper and have an accelerated learning into markets, then you need to look at either the ECOS, which is for the offline traders or the non-active traders, or the WeTrender mentoring room if you are an active trader. This is your program to get deep insights about how market profile and order flow need to be used in a correct way, and to eliminate all the rookie mistakes which normally a lot of retail traders have. Right. So with this, I'd like to call this session to a close. Thank you all for coming in and listening in. Keep your questions flowing. I'm happy to answer all the questions you possibly have about market profile and order flow, and to talk to you about the way we understand it. Our mission is to spread awareness, is to provide education, provide knowledge about how markets work, because that's the thing which is lacking in a lot of retail traders. I lost money because I was not knowledgeable about markets, but now that that education of markets is there, which is what all institutions have. You'll never find an institution which is not knowledgeable about markets. So we have to be like them. We have to know every single thing about how the markets work. And the day you get the power of knowledge on your side, you've got a lot of more. You get a lot more winning trades your way, right? So I'll sign out for now. Thank you all for listening in. There will be a recording of this session which will be there on my Twitter handle. It will be there on YouTube also. Thank you all for coming in.